Hi everyone, and welcome to this mini lecture on financial accounting. We're going to be looking at the financial statements. First of all, me introducing them, and then we'll move on to spend a bit of time looking at each of the three separate financial statements and the importance for a manager. And that's the key point to emphasize here, is that in this particular module called Management Concepts, we are interested in the role that the financial statements and financial accounting play, particularly for the manager. It's not about general interest, it's about how can a manager anywhere in a company make use of the financial statements. So what is a financial statement then? Well, a financial statement in its most general terms tells you where a company's money came from, where it went, and where it is now. And it's divided down into a number of sections, the three main sections being the balance sheet, or the statement of financial position. So it has both of those names. It's fine to refer to them as either. The income statement, also sometimes called the profit and loss statement, again, fine to refer to it as either. And then finally, the cash flow statement. So the balance sheet looks at balancing the books and making sure that assets and liabilities are balanced. The income statement, or the profit and loss statement, is focused on making sure that you've got recorded what's come in and what's gone out. And the cash flow statement is all about where the cash is in your business. So let's break this down in more detail. Before we do that though, let's just briefly look at who uses financial data. We've got a list of stakeholders here. I'm not going to go through each of these in turn. You may choose to pause the video here and look at these different elements. But the key point that I want to make is that with financial data, there are a range of different stakeholders who have different needs for that data. The reason they're called stakeholders is because they have a stake or an interest in the data. You may find that you can even think of others. So the income statement then, or the profit and loss statement, this is where business owners can tell if the business is making money. So in order to determine if the business is making a profit or if it's running at a loss, an income statement, also known as a profit and loss statement, is used. And the income statement records the money going into the business and the money going out of the business. So it's all about whether there's a profit or whether there's a loss. So in the most simple terms, it's money in and money out. If you've got more money coming in than going out, then you have a profit or surplus. If you've got more money going out than coming in, then you've got a loss or a deficit. And so that's what the profit and loss statement is ultimately talking about. What can a manager do with this profit and loss or income statement? Well, reviewing it as a manager will tell you, are you working for a company that's profitable? What's the profit margin of your company? So how much profit are they making? Are the improvement actions that you've decided to take in the past evident in the financial results that have happened? So has it improved the profit margin? Or is there a need for additional action to improve profits and therefore improve that profit margin? The second element is the balance sheet. The balance sheet is where we look at whether the assets balance against the liabilities and the equity. And so it shows a snapshot of your business at a particular point in time. It shows how much the owners have invested in the business and the value of total assets minus the liabilities of the business. So in other words, it shows the net worth. What is your company worth? The key thing is that the balance sheet always balances. So your assets minus your liabilities tell you about your equity or your net worth. What is it that the company is worth? When we think about the different elements of assets and liabilities, we can break these down. So there are a number of different types of assets that a company will care about. The first are the resources that are used to run a business. They could be tangible assets such as machinery, inventory, or cash. They can be intangible too, such as an internet domain name or brand value, if you can find a way of fairly valuing it. We'll look at that again in marketing. You might also have current assets, which are the ones that are available in the short term. So things that are easily accessible, either in cash form or expected to be sold within the next financial year, so not locked up in long-term investments. So it might include inventory, bank, petty cash, or debtors, so accounts receivable, money that you're waiting to get in from clients or customers. And then non-current assets, they're longer-term investments that are used to generate wealth. They're not expected to be sold within the next year, so they can't easily be turned into cash and are non-current. So we can think about assets as being tangible or intangible, current or non-current. Liabilities are another category that you'll see in an annual report within the balance sheet, and they're the amounts that the business owes to the people or the organisation, owes to people or to organisations. Current liabilities are short-term. They're ones that you're going to need to pay back quite quickly. They might include bank overdrafts and creditors. So in other words, people who you owe money for products or services that you bought from them. Non-current liabilities are longer-term liabilities that you're not expected to pay back within the next year. And examples include long-term loans and mortgages. And then owner's equity is another category that features. In the case of a publicly listed company, it would be shareholders' equity. And this refers to the amount of money that the owners or the shareholders have invested in the business. So money that they've taken out of their own pockets and put into the company. That will also include undrawn profits. So where the owners could have taken money out, they've chosen not to. They've left them in the business. Similarly, retained earnings that it can be used by managers, by people working in the company to invest in the business. It's important at this point to clarify the difference between what's an asset versus an expense. So an asset is something that retains its value over a period of time. It might already be in the form of cash, or it could be sold for cash. Whereas expenses refer to resources consumed in the running of the business. Organisations can make a choice about renting or buying, for example, the vehicles they use, and it will differ between therefore being an asset if you own it or an expense if you rent it. So if something is owned, initial cash outflow is held in asset and you can sell it at the end of the useful life, but it will depreciate, reducing value over time, but there's no ongoing expense. Whereas if it's rented, the expenses continue to be incurred until the lease is ended, and you can't convert any of the money back to an asset at the end because you do not own the asset. Petrol would be an expense in either case, but this van would be an asset or an expense depending on whether you owned it or you rented it. And then finally, let's look at the cash flow statement. So the cash flow statement has a number of components, these three major ones. Cash flows from operating activities, they're the transactions that you undertake in the company that form the day-to-day running of the business. So for example, cash receipts from the customers that you supply, or cash paid to your suppliers, your employees for rent and so forth. So money flowing in and out of the business as a basis of what you need to do just to operate. Cash flows from investing activities also feature, so they're transactions that involve acquisition and disposal of non-current assets and investments. So if you buy or sell a vehicle or invest in another business, these would be an investment activity. And that's where the money gets almost trapped in the investment. And then cash flows from financing activities, that's where they're transactions involving you borrowing. So maybe issuing shares, or getting a loan from the bank, or the repayment of loans. So either you're financing or being financed. And the reason the cash flow statement is important for a manager is because a manager who focuses just on profit growth but neglects how much cash its business has got could experience ongoing concern issues if it can't pay its debts. So if it can't pay its suppliers because it has no cash to pay them with because everything's in assets, that's a significant problem. And this happened during the pandemic, where there were concerns that companies wouldn't have enough cash to pay their suppliers and employees and therefore meet their obligations. And governments globally therefore looked for ways to help companies bolster cash so that they could meet their salary bills. So for example, making sure that they had a stockpile of cash that the government maybe helped them with, otherwise they might have run out of money. In normal society, in normal times, though, managers need to balance investment for future growth with ensuring that they've got some availability of cash to pay the commitments that they have on time when they're due. Thanks very much for listening to this whistle-stop tour. Once again, if you want more detail on this, you have the notes, you have the textbooks, and you'll also find heaps of resources about the three types of financial statement online that you can make thorough use of, and you'll find lots of links to some of these on the reading list too. So thanks for listening.